Mike Sanchez.
And I'm Eric Howard.
We're interviewing thousands of people to learn how they manage their finances. Talking about money's super awkward. We're trying to change that. The more open we are about our finances, the more we can learn from each other and improve our own. This is Safe Space Finance, a place for honest and inclusive conversations about money. Welcome to Safe Space Finance. Today we have our esteemed guest, Drew Griffin.
It's like the Arsenio Hall.
Okay. So, Drew, thank you so much for joining us. I'm super excited to talk to you because, I'm certainly a nerd about finances and all that kind of stuff, and I think you sort of are too. We have sort of different approaches, and I think I can learn a lot from you. So I'm eager to get into it. But before we do, I would love for you to just maybe give a little bit of an introduction about yourself so that listeners, viewers can just put you in context and understand where you come from, etc.
Cool. Thanks, Mike. I appreciate the opportunity being on this platform. Just really appreciate the relationship with you, to be honest. We haven't talked in a few years.
Yeah.
You put this out, I reached out. Next thing you know, we're talking on this podcast, and we were hanging out, 10, 12 years ago in D.C. So really appreciate the opportunity.
Absolutely.
For the audience to know who I am, I think it starts and stops with family. I grew up, born in Georgia, mainly grew up in North Carolina, and graduated from East Carolina University. Best decision I could have ever made, going to East Carolina. Prior to that, there's some really key things I think that lay out the fabric of who I am. When I was growing up in North Carolina, just south of Raleigh, in a small town, Fuquay-Varina, I had two older brothers, amazing guys. We're still close, but we never ever knew our father to be healthy. He had a heart attack at 25. He had a stroke at 45. And then the week or two before I graduated high school, he had a heart transplant. Full on, take his old heart out, put his new heart in. It was intense. And so I bring that up because although he was a financial advisor near the later stage of his life, and our family had a very, I'd say, stable environment in terms of emotions, encouragement, just being tight as a family, and a lot of that was breed through trauma. I mean, just being together through my dad's issues, it really set me up on the mindset of long-term vision around financial stability, protection, thinking of the long game, but also living in the here and now. Like whether it's good, bad, or ugly, I'm usually able to find some sort of contentment or solace in like whatever I'm doing.
Yeah.
It could be boring, of like breaking up cement in the backyard that I should probably just pay someone to do it. But, I get value out of doing things that are difficult and, just struggling through stuff. But for me, it's important to mention that because my dad, in the way that he passed when I was 23 years old, definitely set me on a path of like, whoa, what now? I didn't have that voice to call anymore and just, I'd say kick around an idea that I used to. And so these last 15, 14 years since he passed, my life has been a lot of figuring things out, asking mentors a lot of questions, not pretending to know everything, not pretending to know anything, and being just coachable and sort of malleable to whatever the smarter person I'm talking to is sharing with me. So, I'm very, very, very self-aware of my own mortality because of watching my dad and how he struggled through his health and just fought like a wild man to be there for his wife, my mom, my two brothers, and having that understanding of, this is going to end one day, is definitely something that influences my day-to-day living on how I think about, I want to have fun, I want to make memories, I want to build, an exciting life, but I also want to think about on the back end, what's happening after me. I want to be the one that sets the family up, at least in my immediate family, for generational wealth. And everything I can do to get us going down that path, I'm going to do it. And I look forward to getting into that a lot more tonight with you, Mike. And again, thank you for the opportunity.
I'm imagining you must have thought about maybe establishing like a will or a trust to sort of set things up. Did you ever get around to doing something like that?
Literally the 10-year anniversary since my dad passed on August 22nd, 2019. I mean, 3 weeks after Grayson's born, our second child, first son, second child, we signed the revocable living trust, the will, the health directive, the power of attorney. I got all that structure set up. So now all of our assets are is a spillover. We have a spillover clause where everything that we haven't put into the trust yet, at the point of when the trust, gets activated through my or both of our deaths,
Mm-hmm.
everything's going to flow into that trust. And then anything I'm buying asset wise, like our house, it's in the trust.
Mm.
Our bank accounts are in the trust.
Mm.
The whole reason there is you want to avoid probate, and so the will and the trust are doing two separate things. One is giving direction. One's giving clarity. Like the will is kind of saying, to my knowledge, this is where I want things to go.
Mm.
This is how I want it to be provided. And the trust is really a mechanism to activate on that direction and avoid probate to where the county or the state, the court system
Mm-hmm.
will basically look out and say, hey, does anyone have a lien on any of these assets?
Yeah.
Does anyone have any, gripe before
Mm-hmm.
we release, Griffin's assets?
Mm-hmm.
By doing this trust, you sidestep all of that. So I've been very grateful for the advisor that got me set up with this and the lawyer that helped me out. And now I'm at this stage of kind of growing and eventually I want to get into where I have enough assets to where it makes sense to get into an irrevocable trust and
Mm.
have a trustee basically managing that so that I don't own any of that. And then my kids ourselves are the beneficiaries of that irrevocable trust. But you don't do that until your assets are substantial. And you're totally giving up control. You can't bring them back. It's
Mm.
owned by that.
Between you and me, like I've been thinking about it a lot. My wife and I've been talking about it a lot. We have not gotten around to doing it,
Yeah,
but we need to, and we know that's something we need to do. So I'm sure I'll be probing you for some advice there.
sure.
Um, I I know that I've sort of heard you talk about life insurance a lot, and I know that you're deep into whole life as a mechanism for building wealth. Could you talk a little bit about what you're doing in that sort of like whole life play?
Totally. Yeah. So this has been, man, I bet it's been a 6-year journey or almost a 7-year journey of reading about it, researching it, almost doing it. And my financial advisor at Merrill Lynch, he's always had my back and given me great advice,
Mm-hmm.
walked me off of the approach
Well, he
because
was against it.
he was against it.
Okay.
This is in 2000, maybe 19, because what I was trying to do, I was just focused on the borrowing against the policy's cash value.
Sure, yeah.
And he said, wait, you don't need to do that. Just borrow against your brokerage account in what's called a loan management account.
Yeah.
So I'm borrowing against the collateral. It's collateralized against the brokerage account.
Mm-hmm.
So we did that to do what do you call it, a home improvement on the house. We did an addition,
Mm-hmm. Mm-hmm.
and we used that LMA account to pay for that. Now, where things, I guess, materialized to where I ended up going with the policy is I found a group, really by chance. I don't even know how this happened, but was by chance. Social media, Instagram, just following people, going down rabbit
That's how
holes.
it
You know how we
starts.
all do, right?
Yeah.
And then maybe 6 months of following this guy, and um, I just started researching it, going heavy. Like, okay, I need to know how is this a good play? Because some people are talking about it. Like you see the Waka Flocka video, and he's like, "Oh man, once I learned about the trust and the this and the
Uh-huh.
whole life and the
Uh-huh.
that,
Uh-huh.
that got me going." And just started researching. So, long story short, I realized that all whole life policies and all insurance policies, for that matter, are not created equal, especially in this space because whole life, like you talk to Dave Ramsey, he is just uber against whole life.
Yeah.
Don't touch it. Just do term. That's all you need. And I'm like, that's true for the specific purpose that he's talking about, or anyone that's focused on term insurance, which to me is to cover in the event of the unexpected outcome.
Mm-hmm.
You die, you
Yeah.
didn't expect that, or
Yeah,
whatnot.
sure.
From my viewpoint on the reason I'm doing the whole life strategy, which is essentially called infinite banking, is I'm trying to plan for that outcome. I'm trying to strategize on, all right, if I'm heavily leveraged and at risk over here,
Mm-hmm.
say my Merrill Lynch account, and I think this year I'm tax harvesting to the maximum like $3,000
Sure.
in losses.
Mm-hmm.
That's exposure to the market, and I've done great over the years. My advisor, he's the man,
Mm-hmm.
but he can't, just like anyone can't protect against all things in the market. So I look at hedging things like, okay, if I'm heavily exposed here, how can I balance that over here? When I left, or when I got asked to leave the company I was help building, got a little payout, and so I wanted to use some of that money for a risky investment. I went even heavier in the e-commerce play that I did.
Mm-hmm. Mm-hmm.
Um, Another piece of it was I paid off the LMA account to pay for the home edition,
Mm-hmm.
and then the other piece to it, I kind of split it in thirds, but I went after a what's called a high early cash value whole life insurance policy. And when I met this group, it's called Better Wealth. The owner's name is Caleb. Funny story about him. He's like 19, got put into a bank in Minnesota just to be a teller, and he got exposure to like managing customers. And next thing you know, the president kind of just quits, and they're like, "Hey, Caleb, you run the accounts, like you run the relationships. You seem like you're rocking and rolling." He's like 20 in
Wow.
college.
Wow.
But what he learned through that process is just how the banks make money, you know, all the risks that's at play here for individuals.
Mm-hmm.
So he started going on this path of insurance. He wrote a book called The And Asset. I read it, super easy 100-pager, and he just kind of laid out the tenements of what a well-designed whole life policy would look like that would be designed to work efficiently and not be a drag like most whole life policies are, where the one I was going to do a few years prior, if I did, let's say I did $100 premium to start out, I wouldn't have access to more than like $10 of cash value the first year, and maybe 15 the next year. And it was a slow build because the death benefit was really high, and it made and I don't know all the details, but it made the agent severely, significantly make money because of that spread that was there.
Mm-hmm.
And so when I talked to this other guy, Caleb, he was explaining, and Dominic Ruffin, a great guy over there too. He's the COO of Better Wealth. He explained about the specific elements you want in these policies that make it efficient, make it work in the way that it's supposed to. And so there's a few things. You want to get with a company who's a mutual life insurance company, meaning they're not tied to the stock market the way that a stock life insurance company is, like a New York Life, or someone who's still volatile in a
Mm-hmm.
sense. the only four there are, it's like, I think Mass Mutual, Guardian, there's like two others that have been around for like 150 years. And so you want to make sure that you're investing in that type of company, um, that have paid a dividend at least since, you know, the Civil War. I mean, Mass Mutual is who I'm using. They've paid a dividend out every single year for, I think, since 1869. So dividends are not promised, they don't
Sure.
have to get paid, but
Yeah.
they do. And so the whole rub there is, let's say I put in $100 into this policy,
Mm-hmm.
and day one, after about a 2 week waiting period, I had immediate access to $92 of the $100.
Mm-hmm.
So 92%
Mm-hmm.
cash value that I could take a loan against that policy and go do something else with it.
Mm-hmm. Mm-hmm.
Now, some people might buy it or like take the loan and go buy a car or
Mm-hmm.
go buy like some thing or some experience. My mindset has always been take that money, either pay down already established really high debt or go after some sort of cash flowing asset, some real estate or something that, I'm early in this, only a year into the policy, but I just paid the premium for the annual cost, and I just got the dividend, paid to the policy, which was pretty much close to a wash between the interest rate on the loan against the policy and the dividend that the organization is giving me. It was about $100 difference between
Wow.
the interest for the full year
Wow.
of that $92 versus the dividend that they gave me for having the policy.
Can I ask how much is your premium?
Um, every year here's the rub.
Mm-hmm.
The premium is just over, I think, 9 or 10,000.
Mm-hmm.
But then you have these things called paid up additional. They're PUAs,
Mm-hmm.
paid up additional. You're buying the ability to overfund the policy, and
Mm.
so there's a ceiling amount you can do to where it doesn't become what's called a MEC, which is a modified endowment contract,
Mm-hmm.
and that's so that the government will not allow you to just dump as much
Sure.
money as you
They
can.
have to cap it. Mm-hmm.
Correct. So
Yeah.
because the reason is that this money is growing tax free.
Mm-hmm.
It's not exposed to the market
Mm-hmm.
because of the specific companies that we are dealing with.
Mm-hmm.
And then once you pass, the death benefit is usually, most often than not taxed either. So it's a tax-free benefit.
Okay.
So they can't have people dumping in all their money into these policies and then them basically losing out on a tax basis.
So let me just pause here for a second.
Yeah, it's pretty
So
gnarly.
I'm gonna try to make sure I'm understanding, and also if listeners are listening, then help them understand too.
Yeah.
Um, so largely, we're talking about life insurance. Most people get term life insurance. It's like a 30-year policy they pay just in case something happens to them, their family's taken care of. There's this other side of the life insurance business called whole life. You have a whole life policy, and you've established a whole life policy with a lot of specifics. You've been
Yes.
very intentional about the design and who you're doing this whole life policy with. And
Yes.
so the way, just so that people understand the game that you're playing here, you have a whole life policy, and the way whole life policy works is you have a higher premium than you would with term,
Right.
and you are paying cash into this whole life policy. You could think of it as a bank, a pseudo bank. You're
Hmm.
paying cash into this whole life policy and building up a cash reserve in this whole life policy. And the more that cash grows, the more opportunity you have, because you are able to borrow against the cash value. You said earlier that you can't get like 100% of the cash value in a loan, but you can get a really high, 80, 90% of your cash value in the form of a loan. And so if you're paying
Yeah.
tens of thousands of dollars into this thing every year, over the next 5, 10 years, you will have established a pretty decent cash value balance inside of your whole life policy that you can borrow against. Is that sort of how, is that the way to think about it, or am I missing some things? I'm curious.
So there's a couple more pieces to it.
Mm-hmm.
Overall, you're right on point. The other thing to it is, and this book, The And Asset, really lays it out, is that different than, say, my brokerage account that's exposed to the volatility of the market,
Mm-hmm.
these policies, they're growing. It's not an investment in that, like, you're, it's growing very slowly and steadily, usually about 3 to 4 to 5% at most per year inside the cash value of the of the policy.
Mm-hmm.
But the real, like, I guess Jedi trick here is that it's uninterrupted. So think about like 1 year in your brokerage account, you make 25%. You're like, wow, we're crushing.
Mm-hmm.
Then the next year it drops. It just craters
Mm-hmm.
because like what's happening right now,
Yeah. Yeah.
and
Yeah.
it's -5%.
So
So
so this
sure,
thing is not, it's not really experiencing any volatility downside at all. You're just taking only upside. It's small upside, for probably something like 4% or something like that on average, but like it's never going down. And so because it never has to go down and then climb back up, that time spent going down and climbing back up is never experienced. And so that's what
correct.
you mean from uninterrupted.
Yeah, just it's like if you ever read the book From Good to Great,
Mm-hmm.
it talks about the flywheel, and that as the flywheel's turning, it gets easier and easier to turn faster the more times it
Mm-hmm.
turns.
Mm-hmm. Mm-hmm.
So by the time you get, it's really about year, I think it's 5 or 6, when the net cash value and the the annual growth, it becomes to where it's no longer, I mean, it's really moving fast. And I have a breakdown of what that
Mm-hmm. Mm-hmm.
looks like. But the really thing I love about it is it enables me to go forth and conquer and like really drive hard in this direction,
Mm-hmm.
knowing that I've got this thing back here. So as like we go back earlier, we talked about emergency fund. What I do with my emergency fund
Mm-hmm.
is typically build up the emergency fund
Yeah.
and then pull from that, pay my life insurance premium, and in about a day or two, I'm probably going to pull about 92% of that payment back out and put it back in my emergency account.
Okay.
So that I'm essentially putting these dollars to work in multiple places.
Mm-hmm. Mm-hmm.
I'm covering down on that premium. I'm pulling most of it out. And the real like special sauce here is that I don't intend on ever paying back the principal on the loan against the policy. And it's not a loan against the policy. It's a loan from the company, like a Mass Mutual, who's collateralizing the cash value. And the reason I'm not going to pay back the principal, I am going to pay back the interest on an annual basis, which is where the dividend comes into play,
Mm-hmm.
to essentially wipes out a lot of that.
Mm-hmm.
But the key here is, let's just say I have $100 loan against the cash value right now. Over the next 20 years, I take $20 in loan every year, and that's $400 more dollars. So right now after all that, I have about $500 in loans that are outstanding due back to Mass Mutual.
Mm-hmm.
If my policy is $2,000, where my death benefit is, say, $2,000,
Yeah.
when I pass away, all they're going to do is deduct that $500 from the $2,000 death benefit.
Mm-hmm.
And so my mindset is there's a lot more benefit to me using this cash to go buy assets to essentially put the dollars to work in multiple areas.
Mm-hmm.
And then if my family only gets 1,500, death benefit versus 2,000,
Mm-hmm.
it's still substantial.
Mm-hmm.
And what I'm driving in sort of the trust is that payout will be used to fund the next generation's policies. And this is what the Rockefellers do. This is pretty much what they did or are doing versus you may have heard the story of the Vanderbilts.
Mm-hmm.
The Biltmore House in North Carolina. They didn't do stuff like this. They lost all their money within about 2 generations. They were richer than the Rockefellers back in the 1800s. So what will happen is this cyclical effect will happen where you get a policy, I live my life, do everything I'm going to do, I get policies on my children, but they get policies for themselves.
Mm-hmm.
My death benefit funds their policies over the years, and I can define that, within the trust of kind of how this money is going to be used,
Mm-hmm.
and then just turn that cycle. So every time it protects against like Mike getting the family, like let's say I was your dad, I pass, I give you all my money.
Mm-hmm.
Well, now my family legacy is tied to you and you alone not being a knucklehead.
Mm-hmm.
Versus if you frame it around this death benefit used to fund your life insurance policy, and you're say maybe enough to like start a business or
Mm-hmm.
get your first house,
Mm-hmm.
something to get you going. But not every bit of the family's legacy is given to you. Like
Mm-hmm.
there's pieces.
Mm-hmm.
So my mindset is just keep this flywheel turning.
I
So
see.
over the years and writing all this down on what the kids in the future and grandkids and great grandkids can look through, because this is it's not new. These are contracts with these insurance companies. It's not an investment like you would see individual stocks or whatnot. So that's important. And then the other thing that's I think pretty gnarly is when you take a loan against the policy,
Mm-hmm.
it's called non-recognition. And not every company does this, but Mass Mutual is one of them,
Mm-hmm.
where they don't recognize that you've taken a loan against the policy. It's still growing cash value wise as if you didn't take the loan at all.
And so when you take out a loan, do you get to set like how much direction do you have over like the rates that are set, like the interest rates that are set on the loans that you take out based on your collateral and the cash value?
Good question. So last year, the Mass Mutual, for instance, they set a variable interest rate that gets changed once a year.
Mm-hmm.
So it's not tied to the Treasury, the T-bills, like you see Jerome Powell come out there and say, "Oh, we're changing it."
Yeah.
Like a HELOC.
Yeah.
A HELOC is like
Yeah.
all
Yeah.
over the place.
Yeah.
This gets changed once a year on your policy's anniversary date. So last year I had 4.67% interest rate
Wow.
for the entire year.
Wow.
Now this year it's moved up to 5.23, which is still like
Yeah.
not bad.
Well, it's better. I mean, yeah. I mean, most people who are buying homes right now are facing like 8%, 8.5% today. So,
Right.
the fact that you've got that, I mean, I'm sure the cash value in your account doesn't match like a jumbo loan that somebody might get to buy a, $1 million, $2 million home. But still, if you're thinking about taking a loan out for anything right now, doesn't matter what, you're going to be faced with a 7.5%+ rate today.
Totally.
Yeah.
Totally. And I mean, this is where it gets back to people may have said like, "Oh, you're going to be your own bank and you're paying yourself," and this is kind of that concept where you're borrowing against you're collateralizing your policy. You may pay the interest or the principal back to yourself.
Mm-hmm.
I'm just taking the approach of I don't see a lot of value in paying the principal off,
Mm-hmm.
because if my policy eventually becomes, multiple $1 million in death benefit, I didn't receive, a gigantic
Mm-hmm.
inheritance. And I don't plan on just dumping money on Kennedy and Grayson. I plan on designing how it's going to be used.
Sure. Yeah.
But it's still a substantial dollar amount. And I feel like getting use of the money now is way more beneficial than just having this like inheritance or this growth just like metastasizing, but no one's getting any value out of it while I'm living.
So like if you go and you Google infinite banking, you'll find out a lot more about this. But the one thing that Drew said that was super important is that the design of his particular whole life policy is very specific, and it's the design of the policy that allows him to achieve what he's talking about. You could go and establish a whole life policy, and if you mess up on the elements and the components of that design, you may not have the same benefits
Yeah,
that Drew was just talking about. So it's super important to
100%.
make sure you understand the design, and that's what really drives the value.
Totally. Yeah, you'll see products out there that are called Index Universal Life, and that's tied to the market. That's great that it might go well, and there's tons of people that push this this at like a broad level.
Mm-hmm.
I just never got comfortable with any of them until I met this specific group who I just think has a more altruistic approach than, say, your typical
Yeah,
life insurance
that
person.
makes sense. That makes sense. And that's like, I think just with all things with finances is like trust is the first ingredient. Like you need to have that like sort of established trust in order to move forward with almost anything. It's hard to make
Totally.
big moves without having that trust first. So, you know, that's a I think that that's incredible. And it's something, you know, we'll definitely look into, research the hell out of, and try to understand if it can fit for us too. Um,
Cool.
so I think one more sort of topic we can cover, and I think for maybe to close it out, like I'm curious about, uh, so you got this whole life policy. You're using that policy to get advantageous loans that allow you to make other plays. Um, have you considered by chance real estate? Because like I know for us, we're heavy in the market, right? Like we invest a ton. And some days I do feel like, man, I need some alternative assets. But I'm not a crypto person. I tried,
Yeah.
I didn't do well.
Yeah.
uh, I'm not going to go into NFTs. I'm not going to go buy fractional shares of, a Picasso. I'm not, diving into a lot of these alternative worlds like music royalties and from Shrek. Um, but real estate has always attracted me, and it's a very real thing. It it it's tangible, and
Yeah.
I get it. It's not some complex derivatives trading. It's none of that. It's just pretty straightforward. I think
Yeah.
what's always scared me is the the management of it, and like the lack of knowledge, because it feels like a game where you need a ton
Hmm.
of knowledge to be successful. And so that's been a barrier, at least for us. But I'm just curious: are you using sort of the life insurance money to be able to make real estate plays at all, or no?
So we are in the game in a sense. I'm getting close to lining up my first real deal. I've invested in real estate deals as more of a passive investor. Molly's family has been in real estate ever since I've known them.
Mm.
Her dad was instrumental in just kind of waking me up to taking risk. And I grew up in a house where my mom and dad were a teacher, preacher, fixed income. Like
Mm-hmm.
dad wasn't in the position to take like really tough risk. He stretched the money so well when there was nothing there really.
Mm-hmm.
Um, but I kind of had that. I think that trauma of not. I don't want to lose anything. I'll just hold on to it.
Yeah, yeah, yeah.
And Molly's dad, he laughs still because he's like interest rates, 7, 8, 9%. He used to build office buildings in Old Town Alexandria back in the 70s and 80s.
Mm.
And he said, I used to sign $1 million loans with 19% interest. It's
I've
like,
heard people say the same things. It's like, what? What?
I mean, I
Price
can't even
points were probably
imagine.
different, but yeah, makes sense.
But long story short, just being around him, Molly's brothers, they're in real estate. One's a carpenter and general contractor.
Mm-hmm.
The other one's in the development side with her dad. I've learned a lot just being around them. Um, got into a few situations, but also this goes back to kind of why I got an advisor for the brokerage accounts
Mm-hmm.
is that I just determined that I'm interested. I know it's important because there's no other asset that I think is as dynamic as real estate. You think about real estate, like for instance, our primary house.
Mm-hmm.
We have equity, we have through appreciation,
Mm-hmm.
we have a home equity line of credit if we ever really needed to, get access to cash quickly, even though the interest rate is terrible.
Mm-hmm.
We can use that equity kind of as a credit source.
Mm-hmm.
Um, we just did an addition on the house. So if it was, say, an investment property, I can't do this with the primary, but if it was an investment property, I could depreciate all those new, those new appliances, everything that's new, depreciate it, and do what's called a cost segregation study, and actually force the depreciation on all the single items versus doing a broad depreciation over the whole asset. And that's how people always bang on Donald Trump and like all the billionaires and millionaires that like get all these tax breaks,
Mm-hmm.
but they're just doing the code. Like it's not like they're writing the tax code. They're just it's there. Like you
Mm-hmm.
buy an asset and you can depreciate it and take a paper loss. And I'm getting to this stage, but what I realize is that again, trying to do it all by myself,
Mm-hmm.
not going to work. And I don't want to give up the time with my wife and kids for me to figure it out. I'm confident I could,
Mm-hmm.
but there's going to be a school of hard knocks. There's going to be some mistakes made, and what I'm trying to do is limit that. And so I got connected to a group, started an LLC at the end of 2022,
Mm-hmm.
and uh, it's I don't want to say the name because it's in Delaware, so it's got a lot of anonymity, but it's tied to Team Andrew and Molly.
Okay.
So it goes back to us being a team.
Yeah.
That's part of the name is our team aspect. So
Mm-hmm.
um, I'm adding her as a member to the LLC soon.
Mm-hmm.
I just put it as a single member to start
Mm-hmm.
because it's just easier and it goes onto a Schedule C to
Mm-hmm.
your taxes versus being a separate corporate tax return. I should
Mm-hmm.
have just done that, but I was just overthinking it. But long story short, got the LLC, got the bank account, got the EIN number, got the articles of incorporation set up,
Yeah.
got the credit cards with 0% interest for a year, and got into a group called the Flip System. And what they do is you basically pay them a fee, and they sort of compress all this learning together in terms of you've probably seen a lot of learning programs where they give you videos and
Yeah.
like,
Sure.
hey,
Yeah.
here's everything, go figure it out.
Mm-hmm.
Well, their approach is a little bit different. They still give you all that content, but they actually introduce you to teams that already work together on the ground in these environments where there's still a lot of growth to be had. It's not DC, it's not LA, it's not New York, it's those middle of the country
Not
Rust
surprising.
belts. Yeah, I mean like I'm not buying a $400,000 house to like hopefully make a profit on it. It's more smaller plays, same margin. I
Mm-hmm.
mean, but what they're doing is they've introduced me to a property management company, the
Mm-hmm.
realtor,
Mm-hmm.
the inspector, the lawyers, like everybody that they use for their own deals.
Mm-hmm.
They realize that they're at the place where for them to continue scaling, it's not about doing more houses. They want to sell the basically the
Yeah.
strategy.
Yeah.
And
Yeah.
so I've been connected to this group, and now I have a team that I'm already trusting. I know they do it. I know they have a good reputation from the company they work with. They've already done deals together.
Okay.
I'm not going into it cold, being like, man, I hope Mike is trustworthy, and I
Mm-hmm.
hope this guy will do the job, and I wonder if he's going to do a good job. It's
Mm-hmm. Mm-hmm.
it's just compressing all this uncertainty and like high risk of mistakes from my perspective in markets that don't require as much capital.
Like where are they?
I'm gonna be focused in Detroit.
Detroit. Okay.
Yeah, so it's like Detroit, Birmingham, uh, Cleveland, St. Louis, places to where there's still opportunity for development
Mm.
and growth, and it's not so expensive. Where it's like a high risk and high cost. So
And they have people who have like boots on the ground kind of thing, like real, like they go out and they see this, they work in these markets, that kind of thing.
totally. So I'm talking to all people that are already in Detroit and are all working together already. They're already a team. They just introduced me as an investor into working with that team
Oh wow.
that's already established. But they're not like the company, the Flip System. They're just the brokers essentially between people like me
Mm.
and those teams on the ground
I
because
see.
they're using them for their own deals too.
I see.
And
Okay.
I'm not planning to use my own money. I'm trying to avoid that as
Mm-hmm.
much as I can.
Mm-hmm.
I'm likely going to use either a hard money lender, or private money, but mainly my first deal likely do a hard money lender so that I can just see how it goes. And if I have to step in with my own money to like round out the deal,
Mm-hmm.
I'm not afraid to do it, but I want to see how this goes because I'm not going to be able to scale and do enough to hit the goals I want to by using my own cash. I don't want to put
Mm-hmm.
myself in that position. I'd rather this is why you create an LLC and you keep everything in the business side of it versus like on the personal.
Yeah.
Because if things go belly up, it's not
Yeah.
me,
Yeah.
it's the company.
Yeah. And what kind of have they talked to you at all about like from the properties that they're looking to acquire or looking to sort of partner with you to acquire? Is there like a target cash flow range that you've been presented with, or what's that looking like?
Yeah, their approach is very much on hitting base hits and doubles, not like buy this, flip it for like six figures, like it's high
Sure.
risk.
Yeah.
It's really around I'd say the 15 to 20 range of the profit you're trying to achieve. And that goes into analyzing the deal. They have a property tracking system that we get access to. And so their acquisition team is actually doing all the due diligence and then funding and then sending the deals for me to review in my property management system or property tracking system.
Mm.
So I've already got like 15 in there that I'm looking at right
So you get
now.
like a little cube that you're sort of
Exactly.
parsing through.
And their team has reviewed it to say, we think this is a good deal to look at further. And
Mm-hmm. Mm-hmm.
they have various exits between buy and hold, like do no work to it, just get
Mm-hmm.
someone in there to rent it.
Mm-hmm.
A turnkey fix and flip, which means I buy Mike's house, I renovate it to a point where I can put in a renter, and now I've got that cash flow going, and now I'm going to sell it on a
Mm-hmm.
turnkey market. So you're really just getting that added to an investor's portfolio.
Mm-hmm.
Or you could do a retail flip where that's the more traditional aspect of I'm going to, you know, try to sell it before it's actually occupied and try to like
Mm-hmm.
maximize the profit as much as possible. My
Mm-hmm.
mindset is long term, slow and steady. I want to learn a ton. And the whole point is they want us in the program for at least a year. That's what we pay for. And sure, we can stay in it if we want to, but by the third, fourth, fifth, sixth deal, we're probably rolling on our own
Mm-hmm.
and still working with the team that we now have a relationship with,
Mm-hmm.
but not probably having to go through the
Flip
flip system
system.
group
Yeah.
anymore.
Yeah. Yeah. I
If it
imagine
don't,
you've done like 5, 6 deals with this Detroit crew. It's like you know everybody by name and you know you know
yeah.
their
Hey,
family and
Bob.
yeah, yeah. So you
We're eating
can
donuts at that
remove the
point.
middleman at that point. That makes sense.
Yeah, and where
Wow.
people get worried about the distance, like if you ask anyone that says like, "Whoa, you're gonna invest out of state," like
Mm-hmm.
I believe it's actually the right move because when you invest in your backyard, a lot of times that is going to become another job.
The temptation to sort
And
of like be more hands on and
yeah, like, oh, I'll go paint the baseboards.
mm,
I don't want to do that. I want to manage these properties like they're their own business. And
You
I've
want it to
had
be more scalable.
totally
Yeah.
like I don't want to be the property manager. I want to pay someone that I know that we can trust,
Mm-hmm.
and every deal is going to have a little less, profit to it, but that's where you get into that flywheel effect again. The
Mm-hmm.
more you can just keep
Mm-hmm.
that wheel turning versus like squeezing everything possible for that one deal. I
Yeah.
just think that
Yeah.
it'll wear you out.
Well, I love this. I am eager to hear how it goes for you.
Yeah,
And I think I'd love to have you back on the show once you've done your first deal, so we can hear
yeah.
all about that.
Might be
Um,
asking for a loan from somebody. Can someone please help me? I'm in a cold, dark place.
belly up.
Yeah.
Yeah, no, I think you'll do fine. Um, well, look, Drew, I appreciate you coming on and sharing all this knowledge. You are probably the first guest that we've had that is into infinite banking. So I think that is a whole new world for us. And the real estate thing, while that's not new or novel, I do think your approach is interesting. And so I'm interested to see how that goes for you. So, thank you so much for taking the time and being a guest here on Safe Space Finance. And I'll be sure to post sort of all the sort of things we talked about, concepts around infinite banking, the flip system, etc., so that people can get a deeper look at it.